Competitive Landscape Analysis of 2025 Global Economic Strategies. Date: January 24, 2025. Subject: Analysis of how the U.S. aims to outpace the EU and China by 15% market share by 2027. Overview. The global economic landscape for 2025 is marked by a strong ambition from the United States to increase its market share significantly compared to the European Union, EU, and China. The goal is to achieve a 15% market share advantage by 2027, leveraging various economic strategies and responding to prevailing challenges. This analysis synthesizes insights from various economic indicators, policy developments, and geopolitical dynamics as presented in recent economic forecasts. 1. Global Economic Outlook. According to the International Monetary Fund (IMF), global growth is projected at approximately 3.3% for 2025, with inflation expected to decrease to 4.2%. The U.S. economy is anticipated to grow at a more vigorous 2.7%, while the EU is expected to grow only 1%. China's growth is projected at 4.6%. Hindered by structural changes and debt concerns. Key factors influencing these projections include U.S. economic strength. The U.S. is expected to benefit from strong productivity growth, particularly in technology, supported by favorable business conditions and deep capital markets. EU weaknesses. The EU's growth is hampered by low consumer confidence, high energy prices, and structural inefficiencies, particularly in the tech sector. China's structural challenges. China's transition towards a consumption-driven economy is yet to fully materialize, limiting growth and impacting its trading partners. 2. U.S. economic strategies. To achieve its ambitious market share goals, the U.S. is employing several strategic initiatives. Leveraging technology, the U.S. aims to capitalize on its technological advancements and innovation to boost productivity and economic growth. The focus is on maintaining a favorable business environment that encourages investment and entrepreneurship. Policy adjustments. The potential for fiscal stimulus and regulatory reforms under a new administration could further enhance growth. However, risks associated with protectionist policies and high tariffs could also stifle output and increase domestic prices. Geopolitical engagement. Strengthening international trade relationships and addressing supply chain vulnerabilities will be critical as the U.S. navigates a complex geopolitical climate. 3. Challenges facing the EU and China. The EU and China face distinct challenges that the U.S. is strategically poised to exploit. EU's structural inefficiencies. The EU's lack of productivity and innovation, particularly in key sectors, presents a significant barrier to growth. The sluggish recovery from recent economic crises and ongoing geopolitical uncertainties further complicate the EU's economic landscape. China's economic transition. China's reliance on external trade and the struggle to pivot towards a more consumption-driven model are stifling its growth potential. Structural issues, demographic shifts, and debt deflation risks contribute to a challenging economic environment. 4. Market dynamics and risks. The competitive landscape is shaped by various market dynamics and risks, including public debt levels. Elevated public debt remains a concern for both developed and developing economies. The IMF emphasizes that high debt levels can limit fiscal flexibility and hinder growth, particularly in an environment of rising interest rates. Inflation pressures. The potential for renewed inflationary pressures could complicate monetary policy, especially if inflation expectations become de-anchored. The U.S. Federal Reserve's ability to respond to inflation without stifling growth is crucial for maintaining economic momentum. Global trade uncertainties. Trade policy uncertainty, particularly regarding the U.S.-China relations, poses risks to global economic stability. A stronger dollar could also create challenges for emerging markets reliant on dollar-denominated goods. 5. Comparative analysis. The U.S. is strategically positioned for stronger growth relative to the EU and China, but faces considerable challenges. U.S. advantages: a dynamic economy characterized by robust productivity growth, innovation, and favorable investment conditions gives the U.S. a competitive edge. EU's limitations: the EU's structural inefficiencies and slow recovery from crisis impede its growth potential, making it less competitive in the global market. China's structural issues: China's growth is limited by demographic trends and heavy reliance on external trade, creating vulnerabilities for its economic future. 6. Timeline of economic developments. The analysis reflects a broader timeline that began with the economic disruptions caused by the pandemic, followed by the energy crisis exacerbated by geopolitical tensions. The current projections for 2025 are part of an ongoing assessment by the IMF, with further updates expected in future economic reports. Conclusion: as the U.S. sets its sights on achieving a significant market share advantage over the EU and China by 2027, it must navigate a complex landscape filled with opportunities and challenges. The interplay between domestic policies, global trade dynamics, and economic resilience will be crucial in determining the success of these strategies. The evolving geopolitical climate, rising inflation, and public debt levels will remain critical factors as all three economic powers strive for growth in a post-pandemic world. Counterintuitive insights in the competitive landscape analysis of 2025 global economic strategies. 1. U.S. growth versus EU growth. The expectation of the U.S. achieving a growth rate of 2.7% while the EU lags at merely 1% may seem logical given the U.S.'s historical economic performance. However, this projection counters the assumption that advanced economies uniformly recover post-pandemic. The EU's sluggish growth, attributed to high energy prices and low consumer confidence, illustrates how external shocks can disproportionately affect regions that are otherwise economically stable. 2. China's structural challenges. The projection of China's growth at 4.6% contrasts sharply with its previous double-digit growth rates. While it might seem expected for a maturing economy, the analysis underscores a counterintuitive reality: China's shift towards a consumption-driven model is not progressing as anticipated. This reflects deeper systemic issues within China's economy that challenge the notion of its invulnerability to growth slowdowns. 3. Dollar strength impacts on emerging markets. The strengthening of the US dollar is typically seen as a boon for the US economy. However, the analysis reveals a counterintuitive consequence: a stronger dollar exacerbates inflationary pressures in emerging markets which may rely on dollar-denominated goods. This creates an ironic situation where U.S. economic health indirectly undermines the stability of other economies, demonstrating the interconnectedness of global trade dynamics. For public debt dynamics, the high public debt levels in developed and developing economies are often viewed as a temporary burden. Yet the analysis indicates that these elevated debt levels could trigger sudden market loss of confidence, leading to severe fiscal challenges. This insight highlights the precariousness of relying on sustained growth to manage debt, presenting a counterintuitive risk where more debt does not equate to more economic security. 5. EU's productivity shortcomings. The notion that the EU, being a major advanced economy, should have competitive productivity levels is challenged by the analysis. The decline in productivity growth, particularly in the tech sector, reveals a deeper structural malaise that contradicts the expectation that collective European innovation would naturally keep pace with other regions. The lack of startups and misallocation of resources defies the assumption that economic integration ensures competitive advantages. 6. Argentina's economic rebound. Argentina's forecast of 5% growth post-2024 despite severe contractionary measures and inflationary pressures presents a counterintuitive scenario. The expectation of a strong rebound amid fiscal austerity challenges the common belief that austerity directly leads to stagnation. Instead, it suggests that targeted reforms and structural adjustments can sometimes yield unexpectedly robust growth outcomes. 7. Global trade stability. the relatively stable trade-to-GDP ratio despite rising trade tensions and policies contradicts the expectation that increasing protectionism would severely disrupt global trade flows. The analysis implies that businesses may be adapting to new conditions rather than retreating entirely from international markets, indicating a resilience in global trade dynamics that runs counter to prevailing fears of isolationism. 8. Monetary policy divergence. The expectation that monetary policies would uniformly respond to global economic conditions is challenged by the differences in approaches taken by central banks, especially in the US and EU. With the US possibly facing inflationary pressures while the EU remains cautious, the analysis highlights a counterintuitive divergence where economic conditions lead to contrasting monetary policies rather than coordinated actions. These insights reveal the complexity and interconnectedness of global economic strategies, emphasizing how assumptions about economic behavior can be misleading in light of real-world dynamics. In the report titled Competitive Landscape Analysis of 2025 Global Economic Strategies, several key points are discussed regarding the economic ambitions of the US in comparison to the EU and China, aiming for a 15% increase in market share by 2027. While the overall analysis covers important economic indicators and strategies, there are several nuanced elements that readers may overlook which hold significant implications for understanding the global economic landscape. 1. The structural weaknesses in the EU. Many discussions about the EU focus on its slow growth rates without delving into the deeper structural issues that perpetuate these challenges. The report highlights that the EU's productivity and innovation, especially in technology, continue to lag behind the US. This is significant because the EU's ability to compete globally relies heavily on innovation and technological advancement. The lack of a dynamic startup ecosystem and an over-reliance on low-growth mature firms are critical areas that need reform. The implications of this stagnation are profound. Without addressing these structural weaknesses, the EU risks long-term economic decline and reduced global influence. 2. China's transition to a consumption-driven economy. The analysis notes China's projected growth of 4.6%, which is subdued compared to past decades. However, the report emphasizes the ongoing challenge of shifting from an export-driven economy to a consumption-driven model. This transition is crucial not only for China's own economic health but also for global markets that rely on Chinese demand. If China cannot successfully pivot to domestic consumption, it may lead to slower growth, affecting the economies of countries that are trade partners, particularly in emerging markets. This dynamic could exacerbate global economic imbalances and impact supply chains that are heavily dependent on Chinese manufacturing. 3. Risk of debt deflation traps. The report elaborates on the risks posed by elevated public debt levels across different nations, particularly in the context of potential debt deflation traps. This aspect is often glossed over in broader discussions about economic growth but is vital for understanding the fragility of many economies, especially in the context of rising interest rates. Countries with high debt levels may find it increasingly difficult to stimulate growth without exacerbating fiscal vulnerabilities. This could lead to a cycle where governments are unable to invest in growth-promoting initiatives, further entrenching economic stagnation. 4. Impact of U.S. trade policies. While the report indicates that the U.S. aims to leverage its productivity edge, it also warns of the risks associated with potential protective trade policies and high tariffs. This point is particularly significant given the current global inclination towards protectionism. If the U.S. implements high tariffs, it could inadvertently stifle its own economic growth by increasing costs for consumers and businesses. The interplay between trade policy, inflation, and economic growth needs careful consideration, as it can lead to unintended consequences that may harm the very market share the U.S. seeks to expand. 5. The strengthening dollar and its global implications. The report mentions the strengthening of the US dollar and its repercussions for emerging markets, which is an aspect often underestimated in discussions of US economic policy. A strong dollar can lead to increased costs for countries that depend on dollar-denominated debt, potentially triggering financial crises in vulnerable economies. This could create a ripple effect that destabilizes global trade and investment patterns, leading to increased volatility in emerging markets that are already grappling with high debt levels and slower growth rates. 6. The role of central banks and inflation expectations. Another nuanced yet critical aspect discussed in the report is the potential for de-anchored inflation expectations. The implication is that should inflation rise unexpectedly, it could undermine the credibility of central banks that have managed to keep inflation expectations stable. If businesses and consumers begin to expect persistent inflation, it could lead to a self-fulfilling prophecy, resulting in higher wage demands and price increases that could spiral out of control. This dynamic poses a significant risk not just for the US but for the global economy as interlinked financial markets react to these expectations. 7. Global supply chain vulnerabilities. The report indirectly touches upon vulnerabilities in global supply chains, particularly as countries like the US seek to bolster domestic production in response to geopolitical tensions and trade uncertainties. The potential for disruptions in supply chains is a significant concern that can affect everything from production costs to consumer prices. The complexity of global interdependencies means that local disruptions can have far-reaching implications, leading to inflationary pressures that could stymie growth across the board. These overlooked elements are significant because they highlight the intricate web of connections in the global economy. The interplay between national policy's structural weaknesses and global market dynamics will play a significant role in shaping economic outcomes in the coming years. Understanding these nuances is crucial for policymakers, investors, and businesses as they navigate an increasingly complex economic landscape. The ability to anticipate and respond to these challenges will determine not just national economic strategies but also the stability and growth of the global economy as a whole. 1. U.S. economic growth and competitive advantage. The analysis highlights the U.S.'s projected economic growth of 2.7% compared to the EU's 1% and China's 4.6% in 2025. The U.S. aims to leverage its strong productivity growth, particularly in technology, and a favorable business environment to capture a larger market share. This point invites in-depth discussion on the sustainability of U.S. growth, the role of technological innovation, and how these factors may influence global economic dynamics, especially in the face of potential fiscal policy shifts and trade uncertainties. 2. Challenges faced by the EU and China. The EU's sluggish growth is attributed to structural weaknesses in productivity and innovation alongside geopolitical uncertainties. In contrast, China is grappling with a necessary shift towards a more consumption-driven model amid demographic challenges. This presents an opportunity for analysis of the structural reforms needed in both regions to stimulate growth and competitiveness. Discussions could explore how these challenges impact their global economic standing and the potential ramifications for international trade and investment. 3. Market dynamics, public debt, and inflation risks. The IMF emphasizes the risks associated with high public debt levels and inflationary pressures affecting growth in many countries. The potential for protective trade policies and a strengthening dollar to create additional burdens on emerging markets raises questions about fiscal sustainability. This topic is ripe for discussion on the implications of rising debt levels, the strategies countries might employ to manage these risks, and how inflation expectations could shape monetary policies moving forward. 4. Global economic outlook and geopolitical tensions. The broader timeline from the pandemic's economic disruptions to current projections for 2025 underscores the interconnectedness of global economies. The analysis indicates that geopolitical tensions such as those arising from the Ukraine conflict and US-China trade relations could further complicate the economic landscape. This point invites a discussion on how geopolitical factors influence economic strategies, trade policies, and international cooperation, as well as the potential for future economic shocks that could reshape the global economic order. These 4 points provide a comprehensive framework for analyzing the competitive landscape of global economic strategies as outlined in the report, focusing on the US, EU, and China's economic trajectories, challenges, and the broader implications for the world economy. Here are 3 famous historical cases that illustrate competitive economic strategies and geopolitical maneuvers akin to the competitive landscape analysis of the US, EU, and China. 1. The Marshall Plan 1948 to 1952. After World War II, Europe faced economic devastation and the threat of communism. The US implemented the Marshall Plan, a massive financial aid program aimed at rebuilding European economies to prevent the spread of Soviet influence. The plan distributed over $12 billion, approximately $130 billion today, to Western European nations, significantly boosting their economies. This strategic move not only helped stabilize Europe but also positioned the US as a leader in global economic affairs, fostering strong economic ties with European nations and creating a competitive landscape that favored capitalist economies over communist ideologies. 2. The Cold War and the Space Race 1957 to 1969. The Cold War era was marked by intense rivalry between the US and the Soviet Union, particularly in technological and military advancements. The launch of Sputnik by the USSR in 1957 shocked the US and prompted a surge in investment in science and technology, culminating in the Apollo program. The US aimed to outpace the USSR not only in military capabilities but also in technological supremacy. The successful moon landing in 1969 was a significant victory in this competition, showcasing American ingenuity and further solidifying its global leadership position. This period illustrated how economic strategies intertwined with technological advancements could shape geopolitical dynamics. 3. Japan's economic miracle 1950s to 1980s. Following World War II, Japan adopted a series of strategic economic policies that led to rapid industrial growth, known as the Japanese economic miracle. Through government-industry collaboration, Japan focused on technology transfer, education, and export-oriented growth. By the 1980s, Japan had become the second-largest economy in the world, outpacing many Western nations in various sectors, especially in technology and automobiles. This economic strategy not only transformed Japan's economy but also created competitive pressures on the US and European firms, leading to trade tensions and calls for policy shifts in response to Japan's economic ascendancy. These cases reflect how strategic economic policies can significantly alter competitive landscapes on a global scale. Akin to the current analysis of US efforts to outpace the EU and China in market share and economic growth. Future outlook, predictions for global economic strategies in 2025 and beyond. As we look forward to the competitive landscape of the global economy in 2025, the United States has set ambitious goals to enhance its market share by 15% compared to the European Union, EU, and China by 2027. This outlook is shaped by various economic indicators, policy shifts, and geopolitical dynamics that are expected to influence growth trajectories across these major economies. Here are key predictions and insights for the future. 1. Projected economic growth rates. The International Monetary Fund (IMF) forecasts global growth to stabilize around 3.3% for 2025. The United States is anticipated to lead with a growth rate of approximately 2.7%, driven by strong productivity gains, particularly in technology sectors. In contrast, the EU's growth is projected at a modest 1%. Impacted by consumer confidence issues and high energy prices. China's growth is expected to hover around 4.6%, constrained by structural economic challenges and demographic shifts. Key takeaway: the US is expected to maintain a competitive edge over the EU and China in terms of economic growth, primarily due to its robust productivity and innovation. 2. US economic strategies and competitive edge. The U.S. aims to leverage its favorable business environment, deep capital markets, and advancements in technology to outpace its competitors. This strategy includes investment in technology. continued investment in AI, clean energy, and digital infrastructure will drive productivity growth. Favorable policy environment, potential fiscal stimulus measures, and a regulatory environment aimed at encouraging entrepreneurship may enhance economic activity. Addressing inflation, the Federal Reserve's management of interest rates will be crucial in maintaining growth while controlling inflation. However, risks such as inflationary pressures and potential protectionist trade policies could hinder this growth trajectory. 3. Challenges for the EU and China. For the EU, key challenges include low productivity growth, structural inefficiencies, and a lack of innovation in the technology sector pose significant hurdles. Geopolitical tensions, ongoing geopolitical uncertainties may stifle economic momentum and consumer confidence. China's challenges stem from debt deflation risks. A potential pivot towards a consumption-driven economy has yet to materialize, creating vulnerabilities in its growth model. Demographic shifts, an aging population and declining workforce may further constrain China's economic potential. 4. Market dynamics and global trade. The report emphasizes the importance of global trade dynamics, which are expected to remain volatile due to elevated public debt levels. High debt burdens in many countries may limit fiscal flexibility and growth prospects. Trade policy uncertainty, increased protectionism, and potential trade tensions could stifle global trade volumes, impacting economic interdependencies. Emerging markets, particularly those reliant on trade with China, may face significant risks if China's growth continues to slow. 5. Inflation and monetary policy responses. Inflation remains a central concern for all economies. The IMF indicates that while inflation is expected to decline to around 4.2% in 2025, the potential for renewed inflationary pressures exists. Central banks, particularly in the US and EU, will need to navigate this delicate balance of fostering growth while combating inflation. US Federal Reserve. The Fed will likely face pressure to manage interest rates carefully to avoid stifling growth. European Central Bank. The ECB may need to consider unconventional measures such as quantitative easing if long-term yields continue to rise amid slowing growth. 6. Long-term structural reforms. To sustain growth and improve competitiveness, countries must focus on structural reforms that promote innovation, enhance productivity, and improve resource allocation. This includes EU integration. Completing the single market can foster competition and innovation, driving economic growth. China's reforms. Successfully transitioning to a consumption-driven economy will require significant reforms in fiscal policy and consumer behavior. 7. Geopolitical influences and global cooperation. Geopolitical tensions such as those arising from the Russia-Ukraine conflict and US-China relations will have lasting impacts on the global economic landscape. Countries must navigate these complexities while seeking opportunities for cooperation, especially in trade and environmental sustainability. Conclusion. The competitive landscape of the global economy in 2025 is poised for significant shifts, with the US aiming to enhance its market position against the EU and China. While the US is expected to benefit from strong economic fundamentals, the EU and China must address structural challenges to remain competitive. The interplay of inflation, trade dynamics, and geopolitical factors will be crucial in shaping the trajectories of these major economies. Policymakers must remain vigilant and proactive in implementing strategies that foster resilience and sustainable growth in an increasingly interconnected world.